Today we are going to talk about budgets. We're going to start by taking a look at the difference between a budget and a financial statement. A budget is a financial estimate of future income and expenses. So you create a budget looking ahead, guessing, estimating, using data from years past to try to figure out how much income are we going to make next year based upon our shows and our needs, and what are our expenses potentially going to be like. A financial statement, though, is a documentation of past expenses and revenues over a finite period of time. Usually that finite period of time is 1 year. So we're going to look back at how much did we spend and how much did we make in the year 2016, for example. So budget is sort of predicting the future. How much might we spend? How much money might we make? Whereas a financial statement looks at the past. How much have we spent and how much did we take in? Let's talk about the process to actually create a budget. The first step that you want to do is to estimate all sources of income. Now, income for theater comes largely through ticket revenue, people buying tickets, but there are also many other sources of income, and we'll take a look at those in just a few minutes. So once you estimate all those sources of income, you're going to estimate all the sources of expenditures. What are all of our expenses? Royalties, set, costumes, lights, sound, personnel, concessions, toilet paper, cleaning services, buying new machinery, buying thread. All of those things are going to be expenditures. And then you're going to want to, somewhere in your budget, create a contingency fund. A contingency fund is just a little slush fund. You're going to say, we're going to hold back a little bit of money, or we're going to put a little number in our budget. So let's say maybe it's a budget of $5,000, and we're going to call that a contingency. A contingency is sort of like a safety net. It's like a rainy day fund where you say, if somebody's computer breaks down unexpectedly, we wouldn't necessarily know to budget somebody's computer breaking down in our budget. So we probably did not estimate that as a source of expenditure. But luckily for us, we have this little slush fund of money in our contingency fund, and so we can buy that person's computer out of that. So the contingency fund is really set up in case you need to go over a budget for a reason, or there's an unexpected cost. If you don't use the money in the contingency fund, that just goes back in sort of as a source of income, or gets folded into next year's contingency fund. But it's always safe to have about anywhere between 5 and 10% of your total budget as a contingency fund. Now, there's a couple different types of budgeting. One that's really, actually two that are sort of the most popular, and we're going to talk about what those are in this class. Now, there's a few other types of budgeting, but we're not going to worry about those. These are sort of the most common and the ones that you really need to know when it comes to theater. The first is what's called a zero-based budget. And in a zero-based budget, you try to make the income and the expenditure equal the exact same amount. So if I predict that next year, with the shows that we have in our department and all other sources of income, that we're going to have $100,000 of income, then I'm going to create a budget that my expenditures are $100,000 worth of expenditures. That's going to be zero-based, meaning that we expect to spend as much money as we make. Now, that initially sounds counterintuitive. You may think, well, don't we want to make more money than we spend? Wouldn't we want to not spend all of it? Of course. But we're really talking about budgeting the numbers, not actually how much you really will spend. Because you're just guessing that you're going to bring in $100,000 of revenue. You don't know. Maybe you'll only bring in $85,000. In which case, yes, you don't want to spend out your entire expense budget because that's based on you bringing in $100,000 a year. So, these are just sort of a way to make sure that you're not spending more than you're planning to bring in. But obviously, yes, you do want to spend less and bring in more every year so that you do have some profit. The second type of common budgeting technique is called incremental. Basically, what you do is you take last year's actual numbers of income and expenditures, and then you add a little bit more for things like inflation or the price of, wood has gone up. So next year, rather than budget $500 for wood, we'll budget $550. The nice thing about an incremental budget is you're really looking at hard numbers from what you spent last year and what you made last year. The idea being that if last year was a typical year, you could expect to make about the same and expect to spend about the same. So you can either do a zero-based budget based on whatever criteria you want, or you can do an incremental budget where you actually take real numbers from the preceding year and you update those numbers. Most budgets include both of these types, where basically you look at last year's actuals, you add a little bit more for inflation, you add a little bit more because maybe you have a more popular show this year than you did last year, or whatever, and then you still try to zero base it. So the idea being that if we raised all of this money, we would not lose any money because our expenditures equals our income. Let's take a look at some common budget terminology. Now, this is not a business class, this is not an accounting class, but here are a few basic terms that will help you understand, in general, when talking about budgets, what some of these things really are. One we've already talked about, which is contingency. So a contingency fund is just a miscellaneous fund to cover unexpected costs. These would be things that nobody expects, that there's no way to know whether or not they really will happen, but at least you have a little bit of money to tap into should they happen. The next term is deficit spending. So this is actually a financial theory that says you should spend more than you have to in order to solicit better donations and avoid stockpiling money. So let me explain how this works. If last year I budgeted $100,000 of income and $100,000 of expenses, and at the end of the year we came out $20,000 ahead. When I go to donors and I say, will you please give to my theater, we would like you to donate again this year like you did last year. They're going to say, well, do you have any money at all in the bank? And I say, yes, actually we have $20,000 profit from last year. They're going to say, well, you don't need my donation. You have $20,000 in the bank. So no, I'm not going to give to you. I'm going to give to this other organization that needs my money more. So the idea of deficit spending is it would be better for me to take that $20,000 profit and spend it. Buy better machines, buy new equipment, hire more people, so that when I go to that donor and say, we'd like you to donate again this year, and they say, well, how much money do you have in the bank? We say $0. And they go, oh, well, then you really need my money, so here you go. If somebody thinks you're stockpiling money, if you're sitting on this big wad of cash, they're not likely to give you more money or really find a need that to give you anything at all. The U.S. government works on the concept of deficit spending. We cannot ask the taxpayers to pay more tax or make things better if we were sitting on a big wad of their money. So what we do is, as a country, is we spend out that money all the time, which is why we have this huge deficit. We are constantly in debt, so that when we raise taxes, people say, well, I understand why this has to happen, because the U.S. government needs more money because there's not enough money in there. So that's the concept of deficit spending. It seems slightly counterintuitive. If you're a good finance person, you're going to say, but I never want to spend all the money that I have. But in the world of business, sometimes that's the best thing to do. A third term is cost averaging. Cost averaging basically says that you spend more money on some shows and you're going to spend less money on others, but you're going to average a specific amount over the course of a season. So for example, we say if we do 4 shows in our season, the cost, when we cost average them, we make about $5,000 a show. Now, sure, on A Christmas Carol the musical, we're going to make $15,000, and on some small high desert play, we're going to make $2,000. But if we average out all of the income that we receive through ticket revenue for the show, we bring in about $5,000 per show. So you can cost average income, like the example I just gave you. You could cost average expense. We could say in general, it costs us about $10,000 to do costume set, light, sound, props for any one of our shows. So sometimes you just want to cost average things, because sometimes people say, well, I want to give you money for your show and I want to pay for all the stuff. How much is it? Well, I don't know. We haven't done the show yet. I have no way of knowing. So I will just instead cost average and say, well, generally it costs us about $10,000 to do a show. Great. Here's your check for $10,000. Then we have another term called variable costs. Variable costs simply means that there's variations, that one thing might cost more or less than another thing, even though they're the same thing. An example of this is royalties. For plays, royalties are less expensive than they are for musicals. Some expenses, like royalties for professional theaters, are based on an income percentage. So we have no way of knowing what that cost is going to be because we don't have the income yet. So variable cost is just the idea that there are some costs who change over time, either because of what they are or because they actually are the cost of that item is based on a specific income percentage. Variable costs are tricky because it's difficult for you to put together a good budget with a variable cost because you're not 100% sure what exactly to budget. So you just kind of use your best guess. Our final term that I want you to know is marginal cost. Marginal means a little cost. It's basically negligible. For example, if we do 4 performances of a show versus 8 performances of a show, it's not much of a price difference, meaning that, yes, we'd have to pay 4 more royalties, but we don't have to pay more for costumes, we don't have to pay more for actors, we don't have to pay more for using the building, we don't have to pay more for box office staff. So really that's a marginal cost, meaning that we might as well do 8 shows because it's not that much more expensive than doing 4 shows. So marginal cost is often used to describe, like, it's not going to cost us that much more to do it, so let's do it. So this is one example. Now, if we were a professional theater, having 8 shows versus 4 shows is not a marginal cost because we have to pay actors more, and we have to pay more rent on the theater that we're renting, and we have to pay more for the box office person to be there. And, so in that case, in that circumstance, adding more shows is not a marginal cost. But at the amateur level, here at our university, it's a marginal cost. It doesn't cost us that much more to do it. So if the price difference is, to buy 2 reams of paper versus 3 reams of paper, and it's a marginal cost, then we may say, go ahead and get 3 reams of paper, or whatever. So contingency, deficit spending, cost averaging, variable costs, and marginal costs are the 5 financial terms that are used most often in the theater. Again, there are hundreds of others, and in business classes you learn a lot more, but for our purposes, for this class, this is all you need to know when it comes to financial terminology. All right, let's talk about putting together your own budget. So now let's figure out, you've been charged as producer or managing director to figure out the budget for next season or budget for next year's shows. And how do you go about doing that? How do you estimate the cost for some items? There are some basic sort of tenets that don't tell you exactly how much to budget, but you just know that you should budget more or less. The first tenet is that the larger the capacity of the theater, the higher the cost it's going to be to run that theater. A bigger space requires more heat, in the wintertime, more cooling in the summertime, more staff. We have a large theater here, so we have to have ushers for 3 different floors versus a community theater just has to have ushers for 1 floor. So the bigger the theater, the more stuff you have to pay for. The longer it takes your cleaning crew to clean, the more toilet paper you need. So that's one way to sort of cost estimate is if I have a larger space, even though I may have more seats and more income, it may also cost me a lot more to actually use that space. The newer the theater, the higher the cost. We are in a new theater, and therefore we have technologies and computer systems that are running boards for us and controlling electricity. Those kind of high-tech systems, if they break down, you can't have your friend or any old plumber come in and figure that stuff out. To replace, you guys know this for cars, if you have a new car that has a whole computer system and it breaks down, it is far more expensive to get that repaired than some car that was 30 years old. That's pretty basic. That didn't have all of these bells and whistles. The more geographically remote your theater is, the higher the cost. You're going to have less customers that will want to travel out there. They're going to be, you have to probably spend more money on advertising, telling people how to get to your theater. They can shop around for theaters that are closer to them, and they're more likely to go there anyway, so you may have to spend a little bit more time telling them why your plays are better. For you to do shopping trips, if I live in a town with my theater and I'm 5 minutes away from a Walmart, it doesn't cost me very much to go pick up supplies. But if I live an hour and a half away from Walmart, then I'm losing 3 hours every time somebody needs to go on a shopping trip. So I'm losing labor, I'm losing time, I'm losing gas money. So it can also be more expensive if you're geographically remote. The more unusual the programming your theater does, the higher the cost. You have to do extra marketing to explain what a 18th century expressionist play is. There's probably more production expenses. Realism can be cheap because you can go out and find a chair, but if you have to make a chair because you want it to look non-realistic, then you have to buy supplies, you have to pay for people to build it. And finally, affiliations can lower the costs. So one way that you can control your cost is by sharing your building with somebody, by co-producing the play, so they take half the expenses, you take half the expenses, they get half the profit, you get half the profit. Partnering with local businesses, telling the restaurant, if you let our patrons get a discount by eating at your restaurant, you're going to have more people at your restaurant, so you can work sort of partnership deals. So these are sort of just some general theories on whether or not the type of programming or the type of space that you're in is generally going to cost you more or less than another space. Here are 3 budget don'ts, as in don't do these things. Don't spend income before it's earned. It's really tempting to say, well, we know we're going to make about $20,000 in the next show. But you don't know that. You think that. You may believe it with all your heart, but there might be a snowstorm, a rainstorm. It might get a really bad review. The lead actor might drop out and you can't do the show for a week while you're rehearsing an understudy, whatever. So don't spend income until it's actually in your bank account. And you guys know this from your own personal accounts, I'm sure. Don't spend or budget the same dollar twice. Don't say, well, I know I'm getting $10,000 next week from the ticket revenue for this show. Therefore, let's go buy a $10,000 truck for the scene shop. And then a day later go, oh yeah, we could use a couple $100 of that $10,000 to go buy some new office supplies. And let's spend $500 of that $10,000 to go buy a new serger for the costume shop. You've basically spent that same dollar twice. You only had $10,000. You've already allocated it for the truck, but now there's this extra expense. So don't budget your same dollar twice. And finally, rule of thumb, don't get in the boat unless you can afford to sink. Don't open your own theater unless you can afford to lose all the money that you put into the theater. It seems hard sometimes, and it is hard quite often, but you really can make good money doing theater. But you also have to understand that there are some things that are out of your control. You can't always produce a #1 hit play. You don't really have control over that. So just make sure that you don't use your last $500 to open up a theater and hope that your shows will sell. Assume you're going to lose that $500 and then still see if you want to invest. All right, so let's talk a little bit further about estimating expenses. Here are 4 types of expenses and budgets. So the first sort of expense that you have to allocate in your budget is what's called a capital budget. These are one-time expenses. Let's say that you're building a new building. You're only going to pay for that once. So in a capital budget, you may have a completely different set of expenses and income amounts and just have just a capital budget. Buying a new truck, buying a new computer is not something that you have to do every year, so you don't have to put it in your budget every year. But they're sort of one-time expenses. So you can either add those into one giant budget for the organization, or you can separate those one-time expenses and those one-time incomes out as part of a capital budget. Your annual operating budget is your traditional budget. It's ongoing expenses. And your annual operating should not have the influence of productions. So for example, salaries, office supplies, equipment, those are going to be expenses that have nothing to do with the productions. That's just how to keep your organization going. That's what's in your annual operating budget. Pre-production budget are one-time expenses related to the preparation of shows. So in a pre-production budget, this is a payment I only have to make once, but it's related directly to the show, not to the organization or the facility, but to the show. So a director's salary, the scenic budget, an opening night party. These are one-time expenses that once they're paid, we don't have to keep paying for scenic construction after the show is open. We don't have to pay for opening night party after the show is open. So those are one-time expenses related to productions. So those go into a budget called a pre-production budget. And then finally we have the production operating budget. These are ongoing expenses related to the shows. So royalties we pay weekly. Actor salaries we pay weekly. Marketing we pay throughout the run of the show. So those are recurring expenses. So these are the 4 different types of expenses: capital budget, annual operating budget, pre-production budget, and production operating budget. You can potentially have all 4 of these in one giant master budget, or you will split these out and actually maintain 4 different budgets. Income sources. Obviously, the easiest assumption for where most of your income is going to come in from are selling tickets. And that's true. Tickets do make up a very large portion of revenue for theaters. But at most theaters, tickets are not the only source of revenue. As a matter of fact, in some theaters, tickets are the 3rd or 4th highest, but not the highest source of income. Let's look at pricing your tickets. Obviously, you want to price your tickets so that they are competitive in the marketplace, so that they reflect the quality of the experience the audience will get, and that they reflect what that community can actually afford. You don't want to have tickets so overpriced that nobody in the community can actually come see the plays. One way to look at ticket pricing is basically to do something called scaling the house. In scaling the house, you say different areas of the house pay different prices. So if you want to sit close to the front, close to the stage, you're going to pay more for those tickets. If you want to be on the main floor versus the 3rd balcony, you're going to pay more for those orchestra seats. So that's called scaling the house. What's nice about scaling the house is those people who have more money can choose to sit wherever, and those people who don't have as much money can choose to sit in the seats that they can afford. But you don't have one price point so that people can either afford or not afford it. You offer a variety of pricings. Another way that you could scale the house is really called scaling the audience. Don't worry about that. Scaling the audience simply says that you could identify that adults' ticket prices are different than senior citizen ticket prices, and those are different than student ticket prices. So depending on the type of patron, those ticket prices may vary. We scale or change our ticket prices at this theater according to who's coming to the shows. But most Broadway shows scale the house. If you sell every single seat at every single top price, you have a number called gross potential. So gross potential is simply if we have 1,000 seats in our house and we sold all 1,000 seats and we sold every single seat at the highest price we could possibly sell that seat for, that's our gross potential. Gross potential is kind of a nice number because you know that you will make no more money ever than that gross potential. But gross potential is also something that you will never get to. You will never find yourself in a circumstance where every single seat is sold or every single seat is sold at the top price. Now, sure, if you have a small house and it's a hit show and your ticket prices are low, yes. But generally, you won't ever reach your gross potential. If you give out a single comp ticket, suddenly you haven't reached your gross potential because somebody got a free ticket. Press seats are tickets you give to play reviewers for free. Often you'll do discounted tickets. Our Tuesday matinee is not selling very well. Let's do 2 for 1. Or let's do buy one, get one free. Or let's put a promo code out there so that people can get a discounted tickets if they buy them between this time and this time. So you will never see the gross potential. But at least it's a good number to know that you at the maximum amount you could make if everything sold perfectly. Generally, you want to estimate 50% of your total box office gross as income. So basically you want to say, what is 50% of our gross potential? Or what is 50% of, if we sold 50% of the seats, how much would that be? Most theaters for most productions sell between 25 and 75% of their seats. There are very few shows, except the really super hot ones on Broadway, that sell out every single night, every single show. They do exist, but you probably won't work on one of those shows. And even those shows eventually will break down and not sell as many tickets. So generally when you're budgeting how much total revenue do we think we'll make in tickets, budget 50%. If we sold 50% of the house at every single performance, and use that as sort of your number for how much money we could make in just ticket revenue. Now, I mentioned before that there are many sources of income. Tickets are a large one, but not necessarily the largest. Here are all the others. Concessions can make you quite a bit of money, and in certain theaters that have a liquor license or a liquor and food license, they actually can make more money selling concessions than they do tickets. You've seen this happen before. Movie theaters, sports arenas sell more in souvenirs and concessions than the cost of the ticket. So I may pay $12.50 to go sit in the stands at a Seattle Mariners game, but I'm going to spend another $50 on food and souvenirs. So that's pretty common, even in the world of theater. Good concessions can make you a lot of money. Even concessions offered by donation can get you some money. Parking, selling parking spaces, having people pay for parking outside your theater, you can make money that way. Again, in larger cities, they make quite a bit selling parking. Coat lockers or coat checks, you can make money off of that. Souvenir programs, these would be fancier playbills than what you normally get. You see these a lot in commercial theaters where they have more pictures, more insights, Bank account interest. If you have money in the bank account, you can make some interest off of that. So that's an income source. Rentals. If you rent your building out when you're not using it, you can make a ton of money renting it out to other people for other uses. Sometimes it's not that they want to do a show in there, but often businesses have company meetings and they want theaters so that they can do their company meeting on a stage and have their employees sit in the audience. Presentations, educational series, cultural programs, film screenings, reading series, a whole bunch of people might be interested in renting your space. And indeed, you could make a ton of money in that. Tuition from programs, if you offer a children's theater program, acting classes, anything like that, that's an extra stream of revenue. Donations, of course, people giving you money because they believe in what you're doing. Grants are monies that are available to you if you fill out an application and meet the criteria for that grant. So certain organizations have a lot of money and they want to give back to the community to make the community a better place and to show sort of goodwill to the city that they're living in, that they do a lot to help the community. So they will say, look, we've got X amount of dollars, $100,000 allocated each year that we're going to give out in grants. Here's the application form. Anybody who wants to apply for some of that $100,000, fill out the application. You'll tell us who you are, how long you've been in existence. You'll show us your budget from the previous year so we can make sure that you're fiscally responsible. You're going to tell us what you would spend that money on and what impact it would have. Then we will review all of those applications, pick the ones we like the best, give them however much money. New theaters often say, oh, we'll be able to get a lot of grants because we're doing kids theater or we're doing new plays, and there's a lot of grant money out there for that. There's not. In economically flourishing times, there have been lots of grants, but nowadays there are fewer grants, and many grants are going more towards world problems, and they're not staying so much locally. So the grant that maybe came to our theater from our local Target store, now Target at the nationwide level is saying, rather than give a little to the theater in this town, a little to the theater in this town, we're going to give a bigger amount to a bigger major theater in some city. So don't expect much, if anything, in grants. You'll hear people say all the time, oh, grants are free money. It's not. Those applications are difficult to write. They take a long time. They take a lot of information, and you may not get it, and so then it's really discouraging. So that's the situation with grants. And then finally, fundraisers. These are activities you may do for your own organization to raise money for productions or to hire artists, as a way of supplementing the ticket revenue. And these may have some tie-in to the theater, which a lot of times they do. So if we were doing a show that takes place in an earlier time period in, let's say, the 1920s, then maybe what we're going to do is have a fundraiser that's a tea party and have a high tea party, and people can come and drink high tea and have snacks and sandwiches and sit on the stage and feel special for $15, and we'll make money that way, and it will help support our 1920s show. So tickets, concessions, parking, coat lockers, souvenir programs, bank account interest, rentals, tuition from programs, donations, grants, and fundraisers are all potential sources of income. A few miscellaneous things about budgeting. Commercial theater tends to talk about profit and loss because those people either earn a profit or they take a loss. Whereas in non-profit theater, we talk about surplus and deficit. We have a surplus of money or we have a deficit of money. You don't say profit in non-profit because the idea is if it's called non-profit, there is no such thing as profit. There's only a surplus of funds. The goal is to start every single season with a balanced budget. And by balanced, what I mean is a zero balance budget. So that every single year you say, we think we're going to make this much money this year, and we think we're going to spend the same amount of money this year. Budgets are always going to be difficult to predict because there will always be both fixed and variable costs. You will never know with absolute certainty how to budget everything exactly because things will happen that nobody expected. something that's never happened before will happen. Somebody will die and bequeath you all their money and you have way more income than you thought. Or you're going to get sued because somebody got hurt at work and now you've lost more money than you've ever lost before. So there's no way to predict with 100% accuracy. You just do the best you can with the information you have. The information you have comes from how much did we spend and make before, and how much do I think, given the current economic status, do I think that we're going to make more or spend more on. All right, let's talk about assignment number 5. So for this assignment, you're going to create a budget for your first show in your first season. And all this information is available to you on Canvas, so you can look at the handout there. You're going to include amounts for certain line items, and you're going to do a zero balance budget, which means that all the income you predict you're going to make has to equal the exact same amount as all your expenses that you think you're going to expend. The budget sheets and what you need to budget for is available to you on the assignment page on Canvas. If you're unsure of costs for certain things, like how much would a set cost for this play, I assume most of you will have no idea how much things cost for some of these areas. You're going to do some market research. You're going to ask around. You're going to talk to people within the department who build the things and say generally how much would a show that has one set and 5 costumes cost. Or you're going to look online for the data. Or you're just going to use your best guesstimate. But you want to have your guesstimate not be just a number you're pulling out of the air, but something that is based on real numbers. Assume for this assignment that you're an amateur theater company, so you don't have to worry about paying union wages or anything like that. The circumstances to help give you some information to complete this assignment is this. You're renting a theater space for a flat rate of $250 a week for rehearsals. So if you have 5 weeks of rehearsals, you know you're going to spend $1,250. If you have 2 weeks of rehearsals, you know you're going to spend $500. And a variable rate of 20% of the total ticket income for performances. So once the show opens, rather than pay that flat rate anymore, suddenly if you make $5,000 or $5,000 worth of tickets sales, then you're going to pay $1,000 of that for rent. So 20% of the total ticket income. Your space comes equipped with a light board, soundboard, house staff, custodians, and lighting and sound equipment, so you don't have to worry about the cost of those. There are 200 seats in the theater that you are renting. You can sell all 200 of them for each performance that you do. However, going back to our earlier idea that you will probably really only sell about 50% of those, assume that you are only selling 100 of those 200 seats per performance. 75 of those seats will be sold to individual ticket buyers at your top adult ticket price. So the ticket prices that you established in an earlier project for adult tickets, you're going to multiply that number by 75 for the number of seats sold, and multiply that number by the number of performances you have. The other 25 seats will be sold to your season subscribers at 1/3 the cost of your adult season ticket price. So let's say that you set in your earlier project, your adult season ticket price was $90. Well, this is one out of those 3 shows. So this ticket really is worth $30. So you're going to take that $30, which is 1/3 of your adult season ticket price. You're going to multiply that by 25 seats per performance. And you're going to multiply that by the total number of performances. Those equations are actually in the handout, so you can kind of follow along with those. You will have 3 weeks of rehearsals and 3 weeks of performances. So since you have 3 weeks of rehearsals, you know that you're going to spend $750 at least in renting the space just for the rehearsal period. You will have 4 shows per week for a total run of 12 performances. You will have earned $1,000 in donations, so you can add that to your income part of the budget. You will have earned $600 in concessions income, so you can add that into your budget. You will not have any income from grants. So basically, you're going to have donations, concession income, and ticket prices. That's going to be your three streams of revenue. Your expenses are going to be rent and the other things that are listed on that sheet. Your grade for this assignment is going to be based on the accuracy of your numbers. So spend good amount of time researching. Don't simply add a lot of money to donations, which you can't do anyways, to up your income budget, or say everybody is working for free so you can slash your expense budget. Maybe you can have everybody work for free, but people aren't going to work for free if you're spending $10,000 on the set, for example. If you're spending $100 on the set, then yeah, I understand why I'm working for free. But not if you're spending $10,000. Then I think you should pay me something because you obviously have the money. So be very practical and realistic with this assignment. I know right now assignment number 5 seems a little confusing or a little perplexing, which is why I want you to, after this lecture is over, go review and maybe even print out assignment number 5 so that you can take a look at it and really understand what's being asked for. If you have questions on assignment number 5 or what's being asked for, feel free to contact me via email or phone, and I will gladly answer your questions, or we can set up a time to meet. I will also work with you that way. But once you get into it, I think that you're going to find that the assignment's not too crazy complicated. It just requires a little bit of time to get it all organized. That concludes today's lecture on budgets.